Hello, is anybody else here? Ah, there we go. I had hide video participants on. Can you all hear me, just to make sure my microphone's working?
Yeah, loud and clear.
I can hear you.
Perfect, thank you. And let's see, our guest speaker is not here yet. How are y'all doing this weekend?
Good, thanks. Looking forward to a weekend.
Yeah, I am too. I am too. I'm going to my kids' jogathon at 3 o'clock today.
Oh, all right.
Look, I'm not exactly sure how we are helping out, but I'm not exactly sure what we're doing. So I'm hoping it doesn't involve jogging. Maybe just pointing people at which way to jog.
Yeah, I mean, our jogathons, the biggest parent thing was to mark their bibs, right? To see how many rounds they did.
Right, right.
It's really pretty cute. And you write a check.
Right.
And the best thing to write a check is you basically go through community giving that in telecom, and you give them your credit card because they automatically double it.
Mm-hmm. Mm-hmm.
Versus writing a check and trying to get them to match, because that takes much longer.
That is a good point. I'm going to go check out Intel's charity program right now because I think it does qualify.
Yeah, our school, I think Intel is like a $10,000 per person max, but I don't believe there's a organization max, at least for schools.
Okay.
We would probably have, Intel would probably write us a $30,000, $40,000 check for our school, just because there's so many Intel parents there. And the other thing you can do, Daniel, is you can also add the hours you put in. So Intel will pay the school $10 an hour for every hour that you volunteer.
Oh, I didn't know that. Thank you.
Sure.
I'll make sure that happens. Does that work for your wife also, or your spouse?
No, unless only
No,
Intel
just the Intel employee. Okay.
But it includes carpool. I mean, yeah, there's a lot of Intel parents that easily can look for like several hundred hours a year.
Mm-hmm. Oh boy. I spoke to our speaker just a few minutes ago. Actually, probably 40 minutes ago. So hopefully she arrives soon. I'm gonna really quickly send her the link just in case she's searching for that. I see that our speaker is here. Great. Hello, Chandini.
Hey, Daniel. Hi, everyone.
We're going to wait a few more minutes to let people join. We currently have quite a few people registered. Looking the number up right now. You have to pardon me. I've got a little bit of a cough going on, everyone. We have 182 people registered. So we'll wait just a few more minutes to let other people join. And while we're here, I've spent some time actually recently digging into property managers, particularly in the Portland area, but also in California and Arizona for those of you that are in those areas. And hopefully soon, I've had a couple of people, I think you all know that I have a free 15-minute call that I make available to anyone. I'll put the link to the chat if you want that. But I just chat with you as an investor, and I've had a number of people ask about screening their tenants recently. So I am going to bring in some property managers, particularly in the Multnomah County. I know that the laws there have been in flux somewhat. So we're going to bring somebody in to make sure that we cover that area, Portland proper. But we're also going to do the same for Arizona and California, being the three areas that we have the most people in. But if there are any other topics that you would like to talk about here at the Intel REI Education Club, I am getting sick. I can tell in the way I'm thinking. Please take yourself off mute and let everybody know. And I will go look for speakers in those areas. And also feel free to put them in the chat if you don't want to take yourself off mute. I mentioned a little bit earlier on that I'm going to my kids' jogathon this afternoon. And for those of you who don't know about Intel's charity donation matching, please check that out. If you donate to charities, which I hope everyone does, Intel is very generous and they will oftentimes match those charitable donations. So go check that out. And Ashish also let me know just now, and I didn't realize this, that the time that I go over to the school and volunteer at their jogathon, Intel will pay $10 an hour to the school for that. So check that benefit out. And lastly, see, we just crushed the 50-person mark here. Lastly, we are getting to that time of year again. Every 6 months, we go around and bring in new people to be on the leadership committee. The leadership committee basically takes a look at all the people that are coming in to be speakers. We fill out the proper HR forms. We make sure that we're getting the right people in. This year, the leadership committee didn't meet very often. We met about once every 2 months. So it's pretty low key. But if you would like to be on the leadership committee, please nominate yourself. Or if you think that somebody else should be on, I'm going to do that this time. If you think that somebody else would be good on the leadership committee, please nominate them, and we will actually bring all the nominations into here, and I can set up a we can either let the current committee choose, or if we don't get enough, everybody could be invited. So feel free to volunteer if you're interested in reviewing the speakers that are coming into this club. And with that, Chandini, welcome to the group here. You and I have spoke several times over the last 2 weeks, and I'm really glad that you're here. So I'm going to turn the floor over to you. Feel free to introduce yourself and take it away. Questions, go ahead and put them in the chat, everyone, and I will judiciously interrupt Chandini, and we'll do the questions as we go along. Is that okay with you, or would you like to hold them to the end?
No, I'm good either way.
All right, sounds good. Take it away.
Thank you, Daniel. I hope you feel better soon. Hi, everyone. Thanks for giving me an opportunity to be here today. I have some slides that I'm going to be sharing with you. So let me just share my screen and then get going. All righty. So let's go here. All right, so I'm going to be talking with you about our journey. And when I say our, it's my and my husband and our family's journey in getting financially free by investing in one property at a time. My name is Chandini Tangel. I am been investing in real estate for almost a decade, or a little over a decade at this point. I think this request probably you guys anyway practice. Please mute yourself, no video, recording, no pictures. I'm actually gonna show you our own portfolio. So it's a bit sensitive financial information, so would appreciate people being respectful of that, and no pictures, please. Q&A, I'm okay either way. Whenever you're comfortable, feel free to.
Hey, Chandini, we should have a little bit of a quick talk on that, because I usually record these and post them within our members area internally to Intel. Would you like me to edit out any sensitive information before posting it?
That's a good point.
or not post it.
I think just 2 slides. I think if we can edit that, rest should be
Okay.
good. All
Okay,
right?
we'll do.
Thanks. I have been in real estate for a long time and highly passionate about it. So talking with different people, across the globe, actually, when I ask about real estate and have those engaging conversations, some of the things I have consistently seen that comes to the top. And I'm assuming a lot of this would be top of mind for the folks over here on the call as well. So one is, especially the aspiring people like who are just wanting to get started in real estate. I consistently hear, hey, it's very broad. I don't know where to even start. There is a commercial properties, there is residential, then there is these REITs, there is a syndication, there is individual, titles. Where do I invest? There is a long-term rental, there is a short-term rental. The whole area is pretty broad. So very commonly this comes up, I'm new, I want to invest, but I just don't know where to start. Another very common myth, in a way, I would say, is I need large investment, like in large amount of money to get going in real estate. Now, especially people who are on the West Coast or extreme East Coast, for us, real estate is very pricey where we live. So we have this pre-notion that, we need to have a lot of money, like at least 100K, 150K to get going with investment in real estate. And that's absolutely a myth. And you're going to see it in my portfolio and in our family journey, how we got going with smaller investments. Too much of time investment is another thing. We are busy W-2 professionals. We barely get time to take a bio breaks at work, let alone thinking about investing and managing our real estate, right? So I will talk a lot about that too, that you need to be strategic about where you want to invest and how much time you have. And so if you do it very strategically and thoughtfully and intentionally, you'd honestly do not need too much of time investment. Next one, is it worth investing in real estate given growing interest rate? Very, very common top of mind question these days. We just got into a contract in one property earlier this week, and 8.5% is the interest rate. And last year, this time was like 2.75 I got on one of the properties. So it's a huge jump. So I hear you guys, and I'll talk more about the growing interest rate. And then tax benefits. More and more recently, there's been talk around, how real estate can really help with taxation. People ask me, is this really true? How do you do tax savings and whatnot? And that has actually, over the years, become the largest learning for me, like learning about the tax codes and knowing how, as a W-2 income generator, I can offset some of my taxes, all legally using the right tax code. So yes, it's absolutely true. You can have huge tax benefits by investing smartly in REI. And that's what my, a big strategy, our current strategy is, and I'm going to focus a lot on that. And what about risk? Hey, I'm not going to spend too much time on risk. Risk is like with any kind of investment you do, there is a risk. There is nothing risk-free. But is this more of a calculated risk that you can swallow given your risk aversion factor? That you need to, as a family, as a couple or partner, you have to think about that. So that I'm not going to go too much into detail because it really varies from individual to individual. So the agenda for today is I'm going to just quickly give you a bit more about myself, share our journeys, how we did it. So how my husband and I got into real estate and where we stand today. As I said, I'm going to give you a sneak peek into our part of our portfolio. That portfolio is more for people who are just fairly new into real estate. So I'm going to show you how we did when we were getting started. A lot of mistakes. We made a lot of mistakes along the way. So please, I'm going to be calling those out, and I hope you learn from us and not repeat those things. And then tons of learnings. Again, we'll be sharing them along the way. Next, and more so close to the end, I'll talk about how you can do it. Bunch of tips and tricks for you guys. I did not know in this group how many are more seasoned investors versus more beginner investors. So I've tried to have this bit of a broader talk where I'm going to cover, some parts of it more for the people who are just dreaming and thinking about it and just don't know where to start. And then the second half will be more around, if you already have made some investment, given the economic environment today, some of the things how we are thinking. I'm not going to say this is my recommendation to you. It's totally up to you, but I'm going to share how we, being a bit more seasoned at this point, how we are thinking of assessing and reassessing and kind of evolving our strategy right now. So let me start by a bit about me. As I said, my name is Chandini Tangel. I am in the Bay Area. I'm a product leader in enterprise software company over here in Bay Area. I actually turned in my resignation earlier this week, so I am leaving my company. I will be most likely still be in the corporate world for a while, but that's more, I'm not financially dependent on my job anymore. So I'm being a bit more picky about what I do next versus, oh, I need a job because we need to pay the bills. Education-wise, I did my master's at Stanford. I did my undergrad at UCLA. My husband and I are very geeky about financial stuff. So it's not just real estate. We are into a bunch of other investment assets type too, but this conversation, our talk today will be very much zoomed into real estate, but happy to chat with you guys later offline if you want to talk about other financial opportunities out there. We are big into board gaming. Oh my God, especially thanks to COVID. So please, if you have any recommendations or you are into board gaming, please talk to me. I would love to, exchange notes on that. So before I go deeper into the slides, I just want to share with you guys how this whole thing started for us. So almost about a decade back, my husband and I were thinking of starting a family. And when we are migrants to this country, so we don't have, family around to support us, when we are having our babies. So we said, okay, maybe one of us needs to, take a, time off or, take a break from the workforce. And when we did that and we said, let's do our numbers and finances, we realized even though we had very strong income statements, our lifestyle was very much taking away all the income we were making. So if one of us would have left the job with the workforce, we would have not sustained the lifestyle that we have built for ourselves. That was very scary for us to know that we had no choice. We could not leave the workforce. And we looked at each other and we are like, what does that mean? Does that mean we have to delay having the kids? And honestly, actually, that's what we did. We were new, we just did not know. We kind of delayed having our kids. And around the same time, we read this book by Robert Kiyosaki, Rich Dad, Poor Dad. And that book resonated so well with us because literally the phase of life we were in and what we wanted to do, that looks like Robert had already done in his life and was kind of giving that sage advice to newcomers. So if you have not read that book, highly recommend reading that book. It's a very quick 2-3 hour read. But if you don't have time, two things that I would say were a big takeaway for me was number one, Robert said, it's not the rich that pays the highest taxes in this country, it's the upper middle class. And guess what? A lot of us are, we fall into that category just by sheer nature of being in technology industry. Number two that Robert said was, rich focuses on income asset column and poor focuses on income column. And guess what? That's exactly what my husband and I were doing. We were feeling really good about having great incomes in Bay Area, but our asset column was very poor. Now, people talk about, hey, you have your primary home. It's a big asset, to own. I argue having a primary home is not an asset. If you're in any tough situation, you are not thinking of selling your primary home. Asset is something that you can easily liquidify if you need money or whatnot. If your kids have to go to school, you're not thinking of, oh, I'm going to sell my primary home and then I'll send my kids to school. So I don't think we should be counting or banking on a primary home as an asset column. You truly need to have some kind of entity, asset that is going to be generating revenue for you, or it can be liquidified quickly if you need that money in any case. So that's what I think we were missing in our life, for that matter. And then one more thing that I really like the way Robert explained, and that I have summed up in this slide over here, is the 4 quadrants to making money. So Robert talks about, hey, when you look at how money can be generated, there's only 4 ways. So that's this quadrant. Upper left corner is you have a job, you're an employee. That's actually the worst place to be in because you have no leverage when you're in that state. And all of us on this call are really an employee of a company. Now, what that means is you're always going to have a ceiling. As long as there are 24 hours in a day, there is a ceiling on how much you can make. Now, as you go up the ladder, of course, you're making more, but there is still a cap on how much you're going to be making. So not a great place to be in. Then the next one is being self-employed. you own a job, you're still working, you're trading your time for money, but you have flexibility in terms of, you can pick and choose what hours you want to work. The leverage is almost minuscule or close to none still in this phase. So that's really the two areas where you just don't have much leverage when it comes to money, making more money. When we look on the right-hand side, the upper right corner is you then think about being a business owner, where you say, hey, I'm going to own a system, and that system is going to help me make more money, where like, you have a 7-Eleven or a gas station, you have a business, you hire people are your livers, and now you're leveraging them to make more money. You still have active participation to some extent, so I don't consider this as a pure passive income generator, but definitely better than being an employee where you're trading time for money. And then lastly is money working for you, where you are smartly investing. You're picking and choosing the right stocks, you're investing in a real estate. Now the money is being generated for you even when you are sleeping. So that's the point. And that's the area that Robert really emphasized on. You need to focus on systems where money is working for you even when you are sleeping. And so this hit us really strongly. And this was the point that we drove home after reading the book. And we said, and my husband's name is Kapil. So I said, Kapil, what are we doing now? So how are we going to get to that point? So then we started exploring what are those ways that we can generate passive income. Looked around, there are many different ways you can, and we kind of tapped into a few of these, but our favorite one, hands down, is rental properties. So after first 1 or 2 years of exploration, we eventually kind of honed into rental properties. And I would say, hey, time is the key. We got lucky too. This is 2012, 2013. So I'm not going to take all the credit and say we were the smartest couple in the world. Nope, the timing worked in our favor. We invested, and the appreciation was huge. And the returns were better too because interest rate was low. But now after 10 years doing this thing, even now when the economy has changed quite a bit, we are still going strong into real estate. And I'll tell you why in a bit. So talking about real estate, why real estate is my favorite one, really it's threefold. Number one is, the kind of returns you get from real estate for us was unparalleled. Like it was so much better than other investments that we have done. There was a steady cash flow year over year. Now, if you look at a market like California and all, well, there is not that much steady cash flow because property prices are high. By the time you deduct all your capital expenses and your operational expenses, you probably are barely making any money unless you bought a property super cheap at one point and your mortgage rates were lower. But again, many times we are just thinking from the area where we are living. We live in Seattle, we live in Bay Area, and we're just thinking about real estate from that lens. I first tip to you all is start thinking holistically. Just don't focus on the area where you live. Holistically look at what is the real estate doing in different parts of the country. And don't be afraid of tapping into areas that are not easily drivable from your property or from where you live. And that is another very common thing I hear from people. I live in California. How in the world am I going to invest in Ohio? You can absolutely do. There is a very proven system out there. There's so many investors who are remotely investing. So there's already a system there. So there's not a new path you are carving over here. You just need to learn about that path and be comfortable walking on it versus carving a new one. So steady cash flow year over year is a big thing in real estate. It was bigger the last decade, less so now. But when we started, that was a very big attraction. Equity building. Many times we forget somebody else is paying the mortgage. Our renter is paying the rent, and that rent, part of that goes into mortgage. So equity is built in the house, but it's not paid from my pocket. So that's a big benefit. And then appreciation again was very big in the last decade. It's far and few now, but nevertheless, it's real estate, even if it comes down, it does go up. So if you hold tight, you're going to see appreciation. So for us, we saw in our first 5 years after investing since 2012, huge triple benefit that we got from real estate investment. The second one is the substantial tax benefits. And here I'm going to give you tip number 2. We were stupid. And this is one of the biggest mistakes my husband and I did. I am one of those people, in a way, control freak. I want to do everything. I want to learn everything on my own. So I was doing TurboTax and filing my own taxes, not knowing what to do. And I missed a lot of opportunities on having those substantial tax benefits that some of the other savvy real estate investors have when they work very closely with smart real estate professional CPAs. So this learning actually happened a bit later in the game for us. But right now, where we are high income W-2 workers, we are actually more than this first column. I'm actually focusing on the tax benefit. And that's the reason we are still investing in real estate, irrespective of higher interest rate, irrespective of lower year-over-year cash flow, irrespective of not very impressive appreciation. So my point over here is, when we started, we were really playing on this piece. And the first 5 years, we took great advantage of it. Where the economy today is, rather than focusing on the first piece, our strategy has changed. And now we are focusing on the second piece of the tax benefits. And then the third one is real estate in general is less volatile than other, assets out there. So from that standpoint, it's if you're risk averse, this is a bit of a safer area to be playing in. So when, as I said, people talk about real estate is very wide ocean. When you look at real estate investment products, there is REITs, there is syndications, there is partnerships, there is individual. You can just buy individual properties on your name or your, couple's name. And then property types, there is commercial units, there is residential. Within residential, there is single family, townhouses, condos, you just name it. There's a bazillion combinations of these different items that you can do. Same with property acquisition. Should I buy a property that's ready to rent? Should I buy something that just needs little cosmetic upgrades, maybe major rehabs, like really a distressed property? Same with property management. Should I self-manage? Should I have a property manager? Should I do some kind of hybrid approach? What type of rental duration? Should I buy more long-term rentals, maybe midterm, like to corporates, to traveling nurses, maybe short-term rental? So if you're newer, the moment you start thinking about real estate and these are just few different parameters I've put, there is more, your head starts spinning and you're like, okay, I have analysis paralysis. I don't even know where to start. So this is very common that I see among new real estate investors. So we are no different. When we started, we went through all these challenges too. This was overwhelming. Our focus was our W-2 jobs, and we did not know what the heck is going on, where to even start. So then what we said is, hey, you need to just keep things simple. So we said, step number one, we just want to enter real estate market and just have some simple. And now actually, in hindsight, I have put this slide. We were not that smart. We didn't have this kind of clean framework and all when we first started. But now looking back, I'm kind of trying to re-engineer how we got to where we are. So yes, don't be impressed by, oh my God, were you really when you just started, you figured out your strategy? No, we didn't. But given that now we know where we are, I hope this will help you guys. So in the first 5 years, when my husband and I, when we just started talking, we said, one, we are both very focused on our careers. So we can't spend too much time on real estate. Whatever we do, it needs to be as much passive as possible. Number two, we don't know much about real estate. We need to learn. Our biggest thing was we have to learn. And number three, it's so new. I don't want to put too much money into it. We want to just, box the risk that we are going to take. So that's very simple few criteria that we laid out for ourselves. So for you guys too, my recommendation to people who are fairly new in real estate journey is start with the simple criteria that is the most important to you. You may have other criteria too. It's just like when we do product development, you start with a lot of brainstorming, you have a lot of ideas, then you start saying, what is the minimum viable product? What is MVP plus, and then a bunch of the things go in backlog. Use the same approach over here. So for us, time, as I said, we want to be passive as much as possible. Within that also, there are two pieces, acquisition as well as ongoing management. So acquisition was important to us because we wanted to learn, how do you assess a property? How do you even know this deal is a good deal? So we wanted to spend time in acquisition, but management is repeat and rinse. Somebody has to vet your tenant. Somebody has to, make sure the property is operationally working. That part we said we are going to outsource. Learning, we said, let's keep it simple. in the beginning, I didn't quite understand syndications and all. That was hard for me personally. So I said, I'm going to just keep it simple. I own a primary home. I can connect with a single family home. I'm just going to go with that route. Like, so my understanding is simple, like my learning curve is easier. And then eventually we wanted to build a system. We said, we are going to start with some basic learnings, but eventually we want to have a system that Robert Kiyosaki talks about. Third one is very personal to me. I am a little control freak, to confess. And I like to have visibility in what I'm doing. So for me, I wanted to make sure whatever we start with, that gives me full visibility into what we are doing. That meant I may trade off some of my time for it, but then I said, that's okay, but it's very intentional for us. Low investment. We don't want to go very big. We are going to start with small investment. Even if we totally make a mistake, it's very contained. And then low risk. We just, didn't want it too much risk to start out. So with that thing, this is what came to the surface when we were looking at this wide ocean. For us, it made sense to start with some individual single family home kind of properties, like individual that we fully control. So there is no partnership or nothing. Ready to rent. We don't have time to rehab things and whatnot. We are going to give it to property manager once it's up there, once we have acquired it. And we are going to deal with long-term rental because any other rental type requires more engagement. We didn't have time and we were not ready for it. So that's where we started. And so what it came down to for us is, in the first 5 years, we invested in small to mid-size real estate investments that were ready to rent across the country. And then you would say across the country, that requires a lot of time. Yes, that's where we were spending a lot of time on the acquisition side. And that's where we were building our learning, but not property managing. You go on Bigger Pockets. I'm sure a lot of you already know. Bigger Pockets is a great source to connect with other people, and they will really help you get started, especially if you're remote. So we tapped into some of these networks, and we also found one mentor locally who had properties across the country. And then he was able to give us the name of his property manager, some of the sellers from whom he bought. So we kind of leveraged the power of networking, helped us eventually be able to go outside of California for our investment. And then we said, this is again, tip number 3 for you guys. Again, in hindsight 2020, the second bullet point seems like so obvious and common sense, but we didn't start there. Few years into our investments, first, all our bank account, like we had one bank account, our W-2 income and whatever rental income was coming, all flowing into one account. We did not know where we are getting money from, what's the profit we are having or making on our properties. So my point to you guys is, early on your real estate, have one bank account each property. And then so that way, what was your income and what's your profit, what was your projection, actual versus what the projection was, how profitable you are. And that kind of feeds back into, where did you miss on your assessment? So you thought this will give you 20% cash on cash. You only got 5%. So why? Did this property needed more work than you anticipated, or what it is? So it's easier to kind of go back and see where the gaps are or where the successes were. And then once you keep building that in separate bank accounts, eventually, before you know, the power of accumulation, you will have enough money in your accounts to kind of reinvest into the next set of properties. So with that, so for us, when we said, okay, this is what's making sense, we are going to go do it this way, we started our first property that we bought outside of California, more so in Midwest. This was in Ohio. It was a 100K property. And we did 20K down, 20% down, 20K down, and 10K for down closing. So with 30K, we had our first investment. We did spend a lot of time in researching, just knowing and honing onto that this is the right property for us. In terms of the market where we wanted to go, we just went to with our, as I said, with our mentor. He said, you have so many properties, which of your properties is really performing well? So he said, oh, the Ohio market is pretty good. I have consistently seen good performance there. So we said, okay, we are going to get to that. And then we did spend time on kind of just picking up the property that we thought was right for us. So here, these are the 2 slides. My request is not to have in the recording, Daniel. This one actually shows you. So in the first 5 years after we formulated this strategy and we started investing, we bought 8 properties. on an average 100K properties. So you see second column, and ignore the first column. This is more for our internal bookkeeping purposes. But the second column you can see is the property price. Now, again, remember, this started like more so 2014, 15 through 2018, actually 19. So those are the 5 years that we were investing, give and take few months here, there. But we invested in 100K properties across Midwest, Mid-South. On an average, I would say the down payment was 25%. We did buy some all cash. There some were only 20% down, but for simple math, I'm calling it 25%. Tip number 4 for you guys is sometime we just go with the mindset, oh, I need to do 20% down because that's the most standard down payment. But talk with the lender. If you can do 25% down payment, how does it impact your interest rate? So just sometime playing with that down payment percentage you can see improvements on your interest rate side. So this, again, we have learned over the years. So just know you have a leverage, lever over there. So now if you see 25% down payment, then what the dollar values are, that's column number 4 over here, and then monthly rent. Now, when we went in Midwest, Mid-South, one thing I early on learned from other investors is there was a rule of 1% at the time. So you may want to take a note of it. That rule does not exist anymore, honestly. It's maybe 0.8 at this point. But the rule was, if you're getting 1% of the property price in a rent, it's a good investment. Of course, this is very absolute term statement. You have to look at all the other elements as well. But from number standpoint, a 100K property ideally should be giving you $1,000 in a rent. This is again till 2018. This rule was holding very tight, even till 19 and close to 20 in 2020 in some of the areas in the country. But now with that simple rule, let's look at California. You have $1 million property. The max you can get in rent is about $5,000, $5,500 on a property. So you can see that's 0.5. So this rule doesn't fly very well when you look at California. So from cash on cash return, this rule doesn't work for California. But California was a more appreciation market. So you will say, I know I'm not making much cash on cash, but I know I'm investing in an area where my appreciation is going to be higher. And last few years, Austin, Texas area was one of those areas where you may barely have a positive cash flow, but you know that area is so hot, more and more people migrating there. You are more investing from an appreciation standpoint. So my point over here is early on, find out what your goal is. Are you investing because you want a higher cash flow? Are you investing because you need a better appraisal or appreciation in the property? And based on that, invest. An example is, let's say your husband, wife, one of you is planning to leave a job, maybe for the same reason we want to have family, we don't want to work, both of us don't want to work. Then you need high cash flow because you need some steady income coming so that it can kind of offset one of those W-2 incomes that you were having. So if that's the goal, focus on a cash flow property. If you are somebody who are like, I have enough money from my stocks, whatever, our jobs are good, I don't need the returns coming from a property right now, but I just want 18 years down the road when my kid goes to school, I'm able to pay for their school fee and whatnot. Maybe you want to invest in an appreciation market where you say, hey, I know my cash flow might be almost zero right now, but it's going to appreciate in value. And then eventually when I need, of course, all of these has an asterisk sign and fine prints. You never know how things are going to happen. But by and large, you could, I have a property in Texas, which is negative cash flow, but I'm still holding on to it because I'm playing on appreciation in that market. So knowing that what your family goals are, mapping it to your financial goals, and then selecting your properties accordingly is what I'm trying to, get the point across from this slide. So with that, we had a monthly rent. We saw it. Majority of them followed, 1% rule. Higher appreciations were less, like this 137K property. This I bought in Huntsville, Alabama, and you will see, actually, I have a picture of this property. That was not giving me 1%, but we very intentionally invested in that property because we thought that market is going to appreciate well. And then interest rate, for simplicity, I've put 4%. Some of our properties are at 2%, 2.25. Some are more at 6%, but on an average, 4% is where things were. Loan period, again, for simple math, 30%. Tip for you guys is, yes, if you play around with the loan period, you will see a change in interest rate as well. And then rest of these columns are your expenses, your loan payment, your property taxes, your insurance. Another tip for you guys, if you are a busy professional and you want to stay passive, do not cut corner on property management, hire a property management. We always do that for our LTR, long-term rental properties. I don't want to deal with headache and whatnot, especially they are remote, they are smaller properties, not worth my time. I have a property manager. Generally, a good property manager charges you 8 to 10% if your property is long-term rental. So we always factor that into our, when we are doing property assessment. Maintenance and vacancy is subjective. Looking at my portfolio, we are looking at 3 to 5% on an average, maintenance and vacancy. So I've kind of put that number in here. And then the cyan columns, the second and third from the right are your key columns where you see what your real cash flow is and what is your cash on cash return. So when we started investing, of course, 8-10 years back, the returns were great. We even hit, 18%, close to 18% on one of our properties, which is fantastic. And high appreciation properties were still giving me 8 and 9% and 10%. And then hybrids are somewhere in between. They give you some cash flow and they are also in an appreciation market. So that's what our cash on cash return was. Now, if you look at it again, I'm being in Bay Area, I'm going to keep giving you examples of my experience living over here. Look at the real cash flow on my first property. If I don't eat 2 exotic dinners in Bay Area, I can save that much money. So when I looked at these numbers initially, I laughed and I told my husband, really, we are going to go through a gymnastic of buying something that far out in other part of the country for what? Just $300 a month? Like that just doesn't make sense. That's too much stress for very little return in my mind. So individually in absolute terms, honestly, if it's just 1 or 2 properties, this model doesn't make sense. The value of this is in power of accumulation. If you're thinking of buying a lot of these smaller properties and building a portfolio, then it becomes, after a while, very powerful and impressive. And I'll show you how. Now look at the last row over here. So my overall, when I bought the properties, my overall properties prices were $866. This is the purchase price, which is lower than my primary home over here in Bay Area. So my purchase price was lower on 8 properties when compared to my 1 primary home in Bay Area. Down payment, $216K, which is equivalent to or less than, buying a primary home in Bay Area for 20% down. But here is the difference. Your primary home is a liability. To keep it, you are paying some mortgage and property taxes month over month. You're paying the money from your pocket to keep it. These 8 properties were bringing money in my pocket, $8,000 in total in rent. And after all the expenses, I'm looking at $2,300, which is not a huge amount, honestly, but nevertheless, it is something. Now, what you do with this $2,300, I'm going to show you on next slide. Then what my husband and I said, now we are at the end of year 5. We have invested a total of $216K from our pocket. We have 8 properties in our portfolio. If we say there has been 0 appreciation on our properties and they are just at the purchase price, we have an asset of $866K, annual rental income of $95K, and then cash flow of $28,000. This cash flow is enough for me to buy the next property, down payment for the next property without putting any more from my pocket. So if after 5th year, we said no more, one of us is not working and we cannot afford down payment of these smaller homes, we don't need to, because now we are making enough cash flow that we are going to reinvest it. And then from year 5 to year 10, we are going to buy one property every year with the down payment that we saved by the end of the year. And then by year 10, I have 13 properties in my portfolio. Just know from my pocket, I did not put anything more after year 5. So it's still 216, but I have 13 properties, 1.4 million of asset column without appreciation, being very conservative here. Annual income of 161, and now cash flow is 50,000. That allows me to buy 2 properties every year. And so from year 11 through year 15, I'm going to buy 2 small properties every year. Of course, inflation is going to come in play. So the 100K property is going to be 120, 130. But also remember the first 5 years, I was only buying one property. So I was still saving some money from my annual, cash flow. And with the new property, my cash flow was going up. So again, for simplicity, I have kept it this way, but you get the point that it's a little bit more complicated than what's on the screen. But the point stays the same. So year 11 through year 15, we said 2 properties. End of year 15, again, 0 investment from our pocket after year 5, but 10 years down the road, We have 23 properties. Those 8 properties became 23. We have 2.5 million in asset column without appreciation. Our rental income is 300K income. This is pretty much when you look at your W-2 jobs, you look at your income. You know, how much is your, you're getting your gross revenue in a way. This is my gross revenue. Now, after I do all my expenses and everything, 95K is my income coming in. Now, this 95K, having a good CPA, I'm not kidding with you guys. I have barely paid any income on our properties, income tax on my properties, because we make a vacation plan to one place, and then we get the whole travel expensed out of that trip. So I'm paying, not paying for my vacation and all, but yeah, I do go and make sure my properties are fine. So I'm showing legit hours on my property, but there are a lot of ways. I got a laptop. I'm using it 70-80% for managing my properties, keeping up to date on my properties. That's, tax deductible for me. So that's how it grows. So I used to see this, growth chart in the past, and that's literally when we projected our own 8 assets that we have. This is how the trajectory looks. So I totally understand now what what this graph truly means. There are different factors that we take into account when we're assessing a property. I'm not going to go into too much details. You will have this slide so you can look at it. But here's a tip number 5 or 6 to you guys. If you're thinking of investing in real estate as an investor, please take off the primary home owner hat and wear an investor hat on. By that, I mean, this was my biggest problem. I would be spending so much time looking at a school rankings because I'm like, oh, schools is so important when you're buying a real estate or a property. Now, my cash flow properties, let's just think about it logically. My cash flow properties are in an area where rental to landlord ratio is very high. There are more tenants than the landlords in that area. Where would that be? Where people cannot save enough money to do a down payment for a house. What kind of people or jobs are there in those areas? It's more blue collar jobs. People who are just really living paycheck to paycheck. Would they really be focusing on school? Do they have that kind of leverage to be even thinking about schools? Not really. So my investments on cash flow are more so in a blue collar where schools are not ranked very high. I do look for crime rate. I just want to make sure I'm not in a very high crime rate area. So you get the point from here. Certain things that are very important to you as a primary home owner may be of no value or weightage when it comes to investments. So be clear on those things. There are different markets where we have explored ourselves. So already 13 markets where I've bought, sold properties, 100, 200K kind of properties. So point here is there are a lot of areas where you can still get less than 200K properties. As of my speaking today, my husband is in Indiana and Kentucky, and we are looking at amazingly great properties, ranch properties for 400, 450K, huge, like 7 acres of land and a huge property, 450K. So there are still a lot of areas out there where you could find properties that are not that expensive. I'm going to quickly show you a couple properties in our portfolio. So this is my property in Alabama. We bought it for 137K. You saw that it's valued at 185-ish K right now. This was a very rundown property. So this was a property that a flipper had bought and then they flipped it. So we do not close on flip properties until all the scope of work is completed and inspector goes in and inspects the property. So any of you who is looking into some kind of flipping properties, make sure you have that clause in your agreement when you are signing the purchase agreement, that you're not going to close on the property until work is done and inspector has looked through it. So this is the property. I did not want it to scare you with how trashy this property was when we got into contract. It was pretty rundown. But before we closed, this is how this property looked. And this was rented like day one after we closed. 140K property, decent property, bathrooms and all. Again, I'm not looking at a nice yard. I'm not looking at schools. My thing is I'm looking purely from number standpoint. Is it making sense? This is another property that we helped a friend to buy. This was a new build. This is built to rent in Florida. Great property. This has appreciated insanely for him. He bought right before COVID. So he got really lucky with this one. I think the property was 280 or something. It's close to 400 plus at this point. Duplex, actually. And you see, built to rent, brand new property. So really nice from inside. So you can see, my point is 200, 300K, you can get this kind of quality, which I did not know until we really started exploring, because being from California, I was like, oh no, these 200K properties are going to be really trashy. I don't want to even look at it. So that was a wrong mindset. I was bringing my unconscious bias, initially. So that was 5-6 years, but then things happen and the economy started shifting. Interest rates are going up, cash on cash return. What you saw in my portfolio does not exist very much today. Appreciation opportunities are far and few, as I said. So what do? You saw we had already projected our 15, 20 years down the road, and we were like, this is it. We are set. We have these properties. They are going to really help us build our empire of real estate. And we started realizing, you know what, the market is shifting a lot. We can't continue buying these small properties every year with the kind of interest rate we are seeing and whatnot. So my husband and I paused. We said, let's reassess where things are and where market is and what our financial goals are. So we came to a conclusion that the portfolio that we have built is a great launching pad. And anybody who is new, I highly recommend you to please look at these smaller properties. They are less risky and whatnot, and use that as a launching pad to build confidence that need in a real estate. But for us now, where we stand, we have shifted. So now we just are in the second phase of our real estate journey. I call it phase 2, is where we are saying, instead of being passive, we are becoming active. So we are actively managing our properties, getting rid of the property managers wherever possible. And my goal is more on saving taxes, because what I learned along the way is, yes, cash on cash is great, equity building is great, but as a W-2 income generator, number one benefit you can get in real estate is not cash on cash. It's not appreciation. It's not equity building. It's the tax saving. And what I mean by that is we have now shifted into short-term rental, vacation rental market. So we went from 0 at the beginning of this year, and by the time we close this year, plus I have one property it's being built. So by February of next year, we are going to have 5 short-term rental in our portfolio. And we are actively managing those properties. And the reason I'm actively managing, if you spend 500 plus of material participation in your properties, then the losses from that property can offset your W-2 taxes. And when I say losses, it's a loss on the paper, but not necessarily in your pocket. So when you buy a property, let's say you bought $1 million property, you can accelerate the depreciation. So generally a rental property is 29 or 27.9 years it takes, or 29.7, I'm mixing the number. But the point is, it's almost 30 years to depreciate that property. You can accelerate that and say, I'm going to say all my depreciation in the first year. So whatever the depreciation of 1 million is, which is close to about 350K, you can take all of that depreciation in the first year, and 40%, most of us are in 40-45% tax bracket. So 40% of that 200-ish or 400K is like 180K. That's the 180K tax benefit that you are going to have. And that 180K of tax benefit, which shows on the paper as a loss, can offset your W-2 tax. So even after being a high W-2 income generator for us, we are actually expecting Fed to be paying us back some of our W-2 taxes that goes from our paycheck, right? Your company already sends the money to Fed. By the end of this year, we are expecting money coming back to us because we took this route. And now think about it. So if I bought $1 million property, let's say, and earlier this year, we were able to buy $1 million property with only 10% down. So I only did 100K down. With closing and all, it was 110, 120K. And I am expecting 170, 180K coming back from Fed. So guess what? The property that I bought, actually, I didn't pay for it. Uncle Sam paid for it. I was going to pay that to taxes. Instead of paying it in taxes, I did use that money to do the down payment of the property. So literally that property, $1 million property that I bought earlier this year, came for free to me. It's free out of pocket for me, which is very hard for people to wrap their head around. It's free only for high W-2 income generator. It's not necessarily free for other real estate investors. But that's the key point over here. So right now, our strategy has shifted. We are saying we are not chasing this first column right now, our next 4 years, and we are going to focus on our W-2s. We are going to focus on our careers, make good money, offset our taxes, by having this real estate. And then 4 years down the road, both of us are going to be retiring from corporate world. And so I think I've already spoken everything over here. And in the interest of time, I already spoke about this too. So why short-term rental? It's a huge tax benefit. I talked about 3 keywords you should be Googling later on: material participation, cost segregation, accelerated depreciation, and talk about these 3 things with your CPA. If your CPA doesn't know these things, please fire that CPA, hire somebody else who is more of a real estate savvy. And because we are doing this as a vacation rental, our cash on cash return, actually, again, my goal, my number 1 focus is taxes, but hey, on a vacation rental, your cash on cash returns are also pretty good. I'm easily getting 20% cash on cash. But the catch is you do need to have a lot of time to do this. Because we have done real estate for so long, we know how to do this time, and between us, one of us is taking a back seat. So we have time to invest in vacation rental. And I'm just wrapping up. I know, Daniel, there's a lot of questions coming in. We are almost at the top of our hour. In 1 minute, I'm going to wrap, 6 minutes for Q&A. But here is an example of a property, the 1 million property that I told you. We bought it in North Carolina. It's already live. We have bookings till December. That's already going to take care of our mortgage for the whole year. We just went live in July. So we have already, all our expenses, everything is paid off. So from starting January is pure profit for us on this property. And I did not pay for this property from my pocket. Uncle Sam did, as I told you guys. This is an old screenshot. Actually, we have more reviews. Daniel, I don't know, no promotion, nothing. But if I could just share the link of my Airbnb and people can go and heart this property, it helps with my ranking.
Yeah, absolutely.
Is that okay to do? So
Sure.
if people are itching for that, yeah, there's no promotion in here. But if you want to go and live there too, I'll give you special discount, guys. Just tell me where. But I'm going to just put my properties Airbnb over here so you can go and check it out. And please heart it because that helps with my ranking. Anyway, coming back over here. So that's that. I'm going to just wrap up. So 5 mistakes that we did. We did not move fast. Analysis paralysis is the thing. If I have to go back, I wish I would have reduced my analysis paralysis time. Wrong mindset. I was looking at properties to be rented, but thinking of a primary home owner, bad idea. Unclear goal. It took us a while to be clear on, are we investing in cash flow properties or appreciation? Now that you've heard me, I would say get clarity on that early on. We did poor market research. I did not touch on our Oregon property in the interest of time, but we made a mistake, a really big mistake in one of our properties, where when the whole world was making money, like 2015, 2016, I lost money on this property because our market research was very poor. And one time in my life, I tried to cut corner on property management. We had a property in Texas. I did not hire a property manager for a long-term rental. And that was a bad mistake. Again, in interest of time, I won't be able to go into it, but just these are the 5 points that I want you to take home. And then for you guys, how can you get started? Keep things simple. Real estate is complicated. You don't need to know and check all the boxes. Just know what your top criteria is and just focus on those. Like I'm talking a lot about short-term rental. If you're busy people, you don't have time, you don't need to go into short-term rental. You at least know what's out there. Eventually, when the timing is right, jump into it. For you, if you both are high-income W-2s and you want to focus on your career, start with long-term rentals. My first half that I showed you. Then do your homework, quantitative, qualitative, make sure you're focusing on both. Take an action. Many times people say, oh, we know majority of the things you're talking, but they have this problem with not taking action. Stick with it for a while, especially in this economy. If you take an action, just don't get nervous. Property prices are going to go up. Don't just get cold feet on this. Assess and evolve. Don't have that one stagnant strategy. As the market changes, as your personal goals changes, assess and evolve. This last slide will be available to you, but this is really summing up everything I talked about, plus few things that I did not get to touch on, but I really want to make sure I answer some of the questions people have. So yeah, take a screenshot of this or check it out later. But Daniel,
all right, I'm gonna have to pick and choose. We got a lot of questions and we have 3 to 4 minutes left. So first question here, can you share some of your lenders and are you getting good rates on your short-term rentals now?
I'm happy to share. I'll share it with you, Daniel. No, I'm not getting good rates. I told you one of mine, 8.25. I also will tell you guys, my debt to income ratio is pretty high because I just showed you small portfolio, but I have a large property portfolio too, where we have 500,000 to 1.5 million assets. So our DTI is pretty bad, but there is something called DSCR loans, the loans that are given to you without looking at your financial statement. Again, I don't have time to go into detail, just make a note of DSCR, then you guys can Google on that. But yeah, whatever lenders I know, I'm happy to share those.
Do you get DSCR loans on Airbnb properties or short-term rentals?
Actually, DSCR you generally get on short-term rental, not on the long-term.
Okay, interesting.
So DSCR loans are basically loans given to you on the potential of the asset you're buying. So if you are doing vacation rental where cash on cash return is higher, the bank will loan you the money even if you don't have money in your bank or your incomes are not that strong.
Yeah, I usually hear about those when you're buying 5 units or greater on commercial properties,
Vacation
but
rental.
interesting to hear about them on short-term rentals too. Are each one of your properties in their own LLC, and how do you structure the legal?
I love this question, and I am actually going through asset protection, and I'm happy to come back, Daniel, if you think. I have a whole different presentation on asset protection. Few words for you if I never come back over here. One is all your properties should be in individual LLCs, unless the properties are very small in the same location and how much your equity is in them, you can club them together, but otherwise have individual LLCs. On top of it, have a limited partnership established in Arizona. Arizona gives you highest protection in limited partnership, and the general partner of that limited partnership should be a LLC again. That should be established in Wyoming. So sorry, it's a different talk altogether. I'm happy to do a talk on that later.
You know, Chandini, we have been looking for a person to speak about asset protection, so that might be a good fit.
Happy to.
How can we find a good CPA?
Oh gosh, guys, it's taken me 7-8 years to find a good CPA. I have one, and in a way I want to keep it to myself, but no, I'm just kidding. I'll share with you guys, Daniel, I'll send you the name of them. He's very busy. It took me 6 months to get on his thing, but I'll share with you at least their channel. So he has a channel. I learned a lot of the things I'm talking here, I just learned by following him and all the little videos he does. But I'm happy to share all that information with you guys.
Okay, and my CPA is named Mark Perlberg. I like him very much.
So please, yeah, and share yours with me too, because CPA is such a rare asset these days.
Yeah. Okay, what else should we say here? It looks like, Chandini, can you put up your contact information so that people can reach out to you?
Sure.
And in our last minute, we'll just say,
email is, and I'm happy to talk to you guys anytime. My email is Chandini.
Go ahead.
Oh, I just typed it. Was that okay?
Yep, that's fine.
Yeah, so you have my email here. Otherwise, you can reach out to Daniel. He can share mine. So whatever works for you guys.
And last question, does it get much harder or time consuming with more properties?
With LTR, as long as we had long-term rentals, no. I honestly, after a while, economies of scale, it was literally 4 hours a week that we were averaging on our properties. The moment we went into short-term rental, I have to tell you, I had many crying moments this year because I was like, what the fuck did we sign up for? Because short-term rental is a different beast. It is a different beast. I went to North Carolina for 4 days, and I have 2 kids, mind you, the little kids you saw in one of the pictures. And I went there for 4 days, and I was there for 2 weeks. And after 2 weeks, my photographer screwed up the pictures. I had to stay 2 or 3 more days. I was crying my lungs out. So I think now also short-term rental has gotten easier because we have done, it was just learning a new space, like anything else. Even when you switch jobs, it's no different, right? Even if you know your work, but when you switch jobs, there's just a learning curve being in a new company. It was the same for us in short-term rental.
All right. Can everybody take themselves off mute and thank Chandini for coming in and speaking to us?
Thank you.
Thank you, Chandini.
Thank you.
Thank you.
Thank you.
Thank you.
That was great. Amazing presentation.
Yeah.
Thank
Thanks a
you.
lot. Very helpful. Thank you.
Thank you.
Thank you.
All right. And everybody have a wonderful weekend. We'll be back. Same bat time, same bat channel. Bye.
Thanks,
Thank you,
Daniel.
Daniel.
Thanks, Daniel. Bye. Thank you.
Bye.